Hello friends, how are you all? Let us continue corporate finance. This is the fourth video of this lesson and this is the last video of this lesson also. So in this video we are going to study about some of the financial ratios which we could not discuss in the previous video. In the previous video we have studied about the financial ratios or metrics which are used to assess a company's liquidity and profitability. So in the last video itself we have seen this, and before that we have studied about a company's profit and loss statement or income statement and also about the company's balance sheet. So let us continue. Solvency, we have already seen what is the meaning of solvency. Solvency meaning a company's ability to pay off its debts or loans or obligations. Okay. So basically your ability to pay back the loan that you have taken is known as your solvency. So solvency metrics or ratios which are used to look at solvency, they are used to figure out how well a company is positioned to pay off its debts. Okay. So what is the position of a company financially to pay off the loans and debts and different kind of credits it has taken from the different institutions. Now metrics used to measure solvency are, so there are, we are going to study, we are going to see about the 5 metrics for solvency. So current ratio and quick ratio, we have already seen this. These are the metrics used to look at a company's liquidity also, right? So basically liquidity will be used to pay the debts, right? So that's why these liquidity in a way is connected with, paying off the debts or solvency also. So liquidity and solvency, they are interconnected, but there is a slight difference between them. Liquidity meaning the ability to convert your assets into cash, and solvency meaning the ability to pay back your debts. So that is a little bit different, but the cash that you are going to get by converting your assets, you are going to ultimately pay your debts and all. So that's why current ratio and quick ratio are also used as a metrics of solvency. So we know that these are the metrics used to look at the ability to pay the short-term debt obligations, right? So that is short term meaning 1 year, less than 1 year loans and debts, whatever is there, ability to pay these are known as so that ability is looked at by these two metrics, current ratio and quick ratio. So they are also used to look at a company's solvency, because a company's loan may consist of short term loan and long term loan, right? There are both type of loan, short term loan and long term loan. So short-term loan, we already know, we look at the liquidity. For long-term loan, we look at solvency. So basically, overall, we look at the ability of a company to pay back the debt obligation. So we have already seen about the current ratio and quick ratio. If you are not remembering it, please go back to the previous video and you can watch it. Okay. Now in this video, we are going to study about these 3 important metrics: debt to equity ratio, interest coverage ratio, and debt service coverage ratio. Okay, so let us see one by one what are these metrics. So first is the debt to equity ratio. Okay, debt to equity. We already know debt means what? Debt means it is the basically loans, right, or credits taken from the banks, NBFCs, or in the form of bonds. Correct. So they are known as debt instruments. Any loan, any financial mobilization through in the form of a loan from a bank or an NBFC or bonds. Okay, by issuing of bonds. These all are known as debt instruments. This we have already seen in the previous videos, right? In the previous lessons. I think in the financial markets lesson we have seen this. Equity, we know equity means it is the money of the owners of the company, of the shareholders of the company. So that is known as equity. So we have to look at, so whenever a company is established, right, some money is put in by the owners and that is known as equity, and some money is taken in the form of loan from the banks or other institutions. So together, after taking loans and the owner's equity, a company is running its business. Okay, a company is running its business. So we have to look at what is the ratio of this debt, that is a loan taken, to the equity. That is very important, because see, whenever a company goes in bankrupt, or whenever a company is closing down its business, so basically it will liquidate all its asset, and whenever the asset liquidation happens and a company is closing down, it is shutting down its operation, the first payment will be given to the debt holders. This we have already seen. We have seen this, that the first payment is always given to the debt holders, to the debtors of the company, and in the last, if anything is remained, then the equity holder, the owners of the company, will get. That is a normal principle, that is a general principle. That is why the debt to equity ratio will tell you what is the total debt outstanding. I mean, how much of your business you are running through the debt by taking the loan, total outstanding debt divided by the total equity, as to how much is your own money, how much is the money of the owners, the shareholders of the company. So this is also known as financial leverage. See why it is called leverage, because if you say, for example, your total business is say 10 rupees. Okay, the total asset that you have is 10 rupees. Out of this 10 rupees, 8 rupees you have taken as loan from the bank, and 2 rupees you have put yourself. Okay, 2 rupees you have put yourself. So by putting 2 rupees, you are obtaining a loan of 8 rupees to run a business of 10 rupees. So you are leveraging your own money. Basically, leverage means what? See, leverage comes from an engineering term, from a physics term. Basically, this is a lever. Okay, this is a lever. So with the help of this lever, what you can do is, by applying very little force here, you can lift you can lift a very heavy weight here, but depending on what is the length of this bar. Okay, so all the physics and engineering students, they will understand what I am telling you. Okay, this is known as a couple of force. So basically, say for example, if this is if this is say 5 meters, and you are putting a force of say 1 Newton here. So basically you can lift because of this because of this 5 meter length, you can lift a weight of 5 Newton here, because of this 5 meter length. So this is a lever. This is known as a lever. Okay, this is a lever, and lever helps you lift more weight with little force. Okay, with little application of force here. So that's why this entire this entire thing is known as leverage. What you are doing, you are leveraging means with little force, with little of your own force, you are lifting more weight. So same thing happens here with your little money, with your 2 rupees money, you are able to obtain 8 rupees debt. Okay, and you are running a business of 10 rupees with only your 2 rupees. So that's why it is known as financial leverage. Okay, so an example, if for example, if your outstanding debt is 8 rupees and your equity was 2 rupees, so your debt to equity ratio becomes 4. So what does it tell you? That you have a financial leverage of 4. That means you have taken 4 times the loan as your own money. So debt to equity ratio is a measure of degree to which a company is financing its operation with debt rather than its own resources, right? As we already know, debt to, for example, if debt is 10 and equity is 2, so debt to equity becomes 5. So what does it mean? It says that the degree to which a company is financing its operation with debt. So here it is 5 times rather than its own resources. Own resources meaning equity. Own resources means equity. So if a company is having debt to equity ratio of 5, it means that it is leveraging 5 times its own resources. That is a simple meaning. Now you tell me, what if the debt to equity ratio is high? If a debt to equity ratio is higher the debt to equity ratio, it means that there is high risk, because you have taken more loan, right? Your debt is higher than your own money. So it indicates a higher risk. Please try to understand this. Debt is what you have taken from others. Equity is your own money. Your own money, if it sinks down the drain, it is okay. But others' money, the loan you have taken from other, you have to pay back, because you owe that to others. That is not your money. So that's why higher debt to equity ratio means higher risk. Okay. And you always compare debt to equity ratio within the same industry. Again, see, as I have told you, the current ratio and so many different ratios you have to always compare within the same industry. For example, you have to compare the debt to equity ratio of one company say car manufacturing company with another car manufacturing company only. You cannot compare debt to equity ratio of a car manufacturing company with a pencil manufacturing company, because it will not make sense, because some of the companies they require more loan, some of the company require less loan, some of the companies have more equity, some of them have less equity, so like that. Okay, so you have to some of the industries, so you have to basically look at the firms within the same industry. And lower debt to equity ratio, see, if debt to equity ratio is very less also, for example, if your debt is only 1 rupees and your own money is 10, so it is only 0.1. So if debt to equity ratio is very less, it may indicate that a company, that a business is not taking advantage of the debt financing to expand. So see, if debt to equity ratio is very low, what does it mean? It means that you are not able to obtain loans from the market and you are not able to expand your business. Say for example, if you have your own 10 rupees and in the market you are able to obtain 20 rupees as loan because of this 10 rupees and the prospect of your business. So your debt to equity ratio can become 2, but now your debt to equity ratio is only 0.1, say for example. So see, there was a leverage that you could have obtained, you could have expanded your business, you could have made your business even bigger, but you are not doing it. So lower, very less debt to equity ratio is also not good. It is not, it indicates that a company is not taking risk and the company is not expanding its business. So debt to equity ratio should be ideally it should be managed or balanced, and it differs from one sector to the other. Now let us come to the next matrix, which is the interest coverage ratio. Okay, this is the second matrix that we are going to study today, interest coverage ratio. See, I'll tell you, interest means what? The interest that the company has to pay on the loans. Okay, interest that the company has to pay on the loans. Coverage meaning, okay, coverage always means number of periods or months or years or quarters a company can pay. Okay, coverage means what? For example, if I am telling I have a coverage of 5 months, that means I have so much money that I can pay for 5 months. If my interest coverage ratio is say 10 months, that means I can pay up to 10 months. So I have that much money which will be sufficient for me to pay for 10 months, or so higher the interest coverage ratio, it means that you have more ability to pay, right? You have ability to pay for the longer period. So interest coverage ratio. Okay, so interest meaning the interest you have to pay on the loan, and coverage meaning the number of periods. So that period can be months, it can be quarters, it can be years, etc. Okay, a company can pay. Now let us look at this. Interest coverage ratio is the ability of a company to pay interest on the outstanding debt. Okay, interest coverage ratio is defined as, it is the EBIT. EBIT is what? EBIT is your operating income, because see, you are paying your interest from the operating income only, and after you deduct interest payment, it becomes your EBT, earnings before tax, because you subtracted the I from it. Okay, you subtracted the I, you paid the interest from this, so then you obtain the pre-tax income or the EBT, earnings before tax. So EBIT में से ही हम लोग interest pay करते हैं, we pay interest from the EBIT. That's why we have to take here EBIT. Okay, EBIT is also known as operating income, divided by the interest expenses. That is very simple. For example, if your if the interest expense is for 1 year, EBIT you will also take for 1 year. For example, your EBIT for 1 year is say 1 crore rupees. Okay, and your interest expense is say 5 lakh rupees. So basically your interest coverage ratio is 20. So it means that, what does it mean? It means that per annum, annually you have to pay 5 lakh rupees as interest. Your annual EBIT, operating income, is 1 crore rupees. With this annual income, you can pay interest payment up to 20 years. So your coverage is 20 years. Your coverage is 20 years. Interest coverage ratio is 20 here. You can pay interest up to 20 periods, up to 20 years. It depends. See, if your EBIT is quarterly EBIT, if you are looking at the quarterly income, interest expense will also be quarterly. If you are looking at monthly income, monthly EBIT, interest will also be monthly. So it will be the same. So it just tells you the coverage. Okay. Now lenders, investors and creditors use this ratio to determine a company's riskiness relative to its current debt for or for future borrowing. So for example, if a company has a very less interest coverage ratio, for example, if a company has interest coverage ratio of only 2, so what does that mean? It means that with its current income, it can pay interest for only next 2 months or next 2 quarters. And if another company, it has an interest coverage ratio of 10, so it means that that company can pay interest for next 10 months or for next 10 quarters, depending on what period you are looking at. So if you are looking at months, you will say 2 months. If you are looking at quarters, you will say 2 quarters. Okay, it depends. So if the interest coverage ratio is 2 and another company interest coverage ratio is 10, it means that it is more risky to give loan to this company because it has interest coverage ratio of only 2. Because see, interest coverage ratio is the interest that you have to pay on the current loan that you have already taken. Now in the future, if you want more loan, the banks will look at this number, because they will look whether you are able to pay your existing interest or not, how much you are able to pay your existing interest, and how much a bank should lend you in the future. Because if you have less interest coverage ratio, it will be more risky for bank to further pay you, to further give you loan for future borrowing. Okay, so basically so one very important thing is that interest coverage ratio evaluates both present and emerging risk. Okay, so interest coverage ratio indicates what? It indicates that how much is your present risk as to how much loan you have, how much payments you can do, and in the future also if you take on further loans, if you take more loans in the future, then your interest coverage ratio will further go down because your interest expenses will increase. For example, if your interest payment now was say 1 lakh rupees and you take more loan, from the next year onward you will have to pay 2 lakh rupees as interest. So if your interest payment is increasing, that means your interest coverage ratio will fall. If it will fall, that means there will be more risk in the future. So it talks about both your present risk as well as the future risk, and the banks, creditors, investors, everybody will look at this interest coverage ratio. It is very, very important factor. I have already explained it to you. Coverage means the number of periods, quarters or fiscal financial years interest can be paid with the company's available earnings. This we have already seen. Lower the ratio, more burden on company of the debt expenses, that is less ability to service the debt. Higher the ratio means better ability to service the debt. Remember, coverage is more. Okay, higher means high coverage, more coverage. Lower means low coverage. Just try to understand this, remember this. Now similarly, when we talk about another metric, which is the debt service coverage ratio. Okay, see, again it is the just like the interest coverage ratio, it is also the coverage, meaning it will also indicate the number of period, same thing, but here it is about the debt service. Okay, debt service, that was interest payment. See, you take debts, in debt you pay interest you pay monthly or annually or quarterly, and in the meanwhile you also have to pay back the principal also, right? The principal amount also you have to pay back. So that is your basically debt service. Basically, are you able to pay back your debt, your principal or not? That is your debt service. So it is similar to ICR, similar to interest coverage ratio. Again, it is defined as net operating income divided by the total debt service, the total outstanding debt, the principal amount along with the interest that you have to pay in a given year. That is your debt service. Okay, so net operating income is nothing but your EBIT. Okay, so what does DSCR, that is debt service coverage ratio, tells you? It shows for how many periods can the company service its debt with a given income for the given period. Okay, same as ICR. And DSCR is less than 1 means what? It shows that a potential solvency problems. See, if DSCR is less than 1 means what? It means that, for example, if your operating income, for net operating income for a given year, say 1 crore rupees, but you have to pay back say 1.5 crore rupees. So that means you will not be able to pay your debt for that year. So it has a solvency issue. Okay, a company may default on the payment, on the debt payments, because its operating income is only 1 crore rupees. How can it pay 1.5 crore rupees of principal and interest to the bank return? Because so basically this company may become insolvent. There is a potential solvency problem here. So it less than 1, it always indicates a potential problem of a company. Okay, debt service coverage ratio. So friends, this was all about the corporate finance. It was a very small lesson, only 4 videos was there. Actually, corporate finance lessons, this is a very broad topic, very big topic, but we don't need to go in very much detail, and that is not important for UPSC exam also. This much I feel is sufficient. You need to know a little bit about the company and corporate finance also, given that a lot of news is coming these days about the companies and stock markets, etc. So we should know this very, very small things, because these terminologies you may also find in newspapers, and I hope this will be beneficial to you now. Once you read the newspapers, if these terminologies you come across, you will be able to understand them. So if anything more you require on this, please mention in the comment box. I'll try to explain it to you. Maybe I'll make 1 or 2 more videos if anything is left, and if you feel that I should cover it. Okay, so all the best. I'll see you in the next video, next lesson. Thank you.